So let's talk about how small apartment investors can review their portfolio performance. It's important to keep an eye on a few key areas to really understand how your investments are doing over time. First up is rental income. You'll want to track the rents collected from your apartment properties and, compare those numbers to your original projections. This helps you see if your properties are meeting your expectations. Next, let's look at appreciation. It's a good idea to monitor any changes in your property valuations and compare them with local market trends. That way, you can get a sense of how your investments are growing in value. Finally, expense tracking is key. Take some time to evaluate how your operating expenses impact your net operating income, or NOI, and your overall portfolio returns. This step really helps you spot areas where you might improve your bottom line. Let's take a closer look at asset-level performance. Here, we analyze how each individual property is doing by considering important metrics like occupancy rates, cash flow, and capitalization rates. These numbers help us understand, which assets are performing well and which might need a bit more attention. Next, it's important to evaluate metrics and benchmarks. By comparing key performance indicators to industry standards, we can get a clearer sense of how our investments stack up and where there's room for improvement. Now let's move on to portfolio-level analysis. We calculate the total return, Sharpe ratio, and income yield for the entire portfolio. This gives us a big-picture view of overall performance, helping us make more informed decisions moving forward. Now let's compare performance metrics to some key indices like the MSCI US REIT Index, municipal bond indices, or, other relevant benchmarks. Next, we'll assess volatility and diversification to figure out if the portfolio's risk-adjusted performance really aligns with your objectives. Finally, it's important to identify areas for improvement so you can keep moving closer to your financial goals. Now, let's take a closer look at underperforming properties. It's important to review any properties that have declining rents, high vacancies, or, excessive maintenance costs. Next up, it's time to rebalance allocations. That means reallocating capital from underperforming or high-risk assets to, more stable or higher growth opportunities. And finally, let's talk about optimizing financing. Consider refinancing high-interest loans or restructuring debt to improve cash flow and hopefully boost your returns. Now let's create an action plan. Next, it's important to establish performance thresholds to trigger rebalancing or divestment decisions. And don't forget to schedule regular portfolio reviews, just to stay on track. Okay, so let's dive into an example of analyzing portfolio performance metrics. Here's a scenario for you. Imagine a small apartment investor who owns 3 properties. The first property, Property A, is valued at $500,000 with a net operating income of $40,000, and it appreciates at 3% annually. Alright, so Property B has a value of $300,000 with a net operating income of $24,000, and it appreciates at 2% annually. Now moving on to Property C, it's valued at $200,000 with a net operating income of $16,000 and, it appreciates at 1% annually. Let's take a look at the overall portfolio metrics just to get the big picture here. So the total value comes to $1 million. The total income yield is, $40,000 plus $24,000 plus $16,000 divided by $1 million, which equals 8%. Now let's look at the total return including appreciation. So the net operating income here is $80,000. The appreciation comes out to, well, $500,000 times 3% plus $300,000 times 2% plus $200,000 times 1%, which totals $19,000. When you add it all up, the total return is, $80,000 plus $19,000 divided by $1 million, giving us a return of 9.9%. So let's take a look at the benchmark comparison. The real estate benchmark return, by the way, is 10.5%. Well, here's the analysis. The portfolio actually underperforms the benchmark, mostly because of the low appreciation on property C. So here's the action plan. Consider repositioning or selling property C to reinvest in higher growth opportunities. Explore cost-saving measures or rent increases to improve net operating income for all properties. So let's talk about the benefits of regular portfolio performance monitoring. By keeping a close eye on your investments, you can, make more informed decisions and stay aligned with your financial goals. Enhanced portfolio resilience is another key advantage. Regular monitoring helps you adapt to market changes and, honestly, better withstand unexpected downturns. Timely identification of underperforming assets allows for proactive adjustments. This way, you can address issues before they impact your overall returns, which is, well, pretty important for long-term success. Optimized returns are, all about making sure your investments are working as hard as possible for you. Regular evaluations ensure investments align with market conditions and financial goals so you can stay on track and, well, adjust as needed. Data-driven decisions, honestly, give you the confidence to move forward with strategies that are backed by solid information. Performance metrics provide objective insights for refining investment strategies. Risk management. Monitoring ensures the portfolio remains balanced and within acceptable risk parameters. So, in summary, monitoring and reviewing portfolio performance is essential for small apartment investors to achieve their financial goals while managing risk effectively.